In today's video, I'm going to share how to build wealth in 7 steps. No matter where you are in your wealth building journey, the tips I'm about to share will help you to grow your wealth in the long run. The end goal is to help you build a $1 million saving.
$1 million.
Now, while these steps are proven to work, keep in mind that this is not a get-rich-quick video. These 7 steps do take time and they work like a cycle that you have to repeat over and over again to build wealth throughout your life. And as always, if this is your first time here, thanks for dropping by. My name is Thomas. This channel is to help Canadians to make better choices on retirement, wealth, and insurance. My goal is to make sure you take 1 or 2 ideas home so you make better financial decisions onward. If this is something that you're interested in, make sure you click the subscribe button below. Let's get started. Before we can have $1 million in the bank account, we have to understand what already have and what we need. Do you know how much money you make each year? And how much is left after tax? And probably the most important question, in order to reach to your financial goals, how much money do you need to save? Get clear on your current income, spending habits, tax burdens, and savings before you set out to build wealth, as this is your foundation. Cash flow is simply income minus expense. Is there any way to increase your income and decrease the expense? Then the next step to build wealth is to clear your bad debts. And how I define them are debts that are not yielding any financial returns. The thing is, most Canadians have some kind of debts. Usually, we have something like a mortgage, a car loan, or student loans. But these are good debts with low interest rate, usually below 4 to 5%, and in return, you're receiving a higher amount of income, and your investment should be high enough to cover your debts and still give you gains. For example, if you pay 3% interest on your debts, but you get a 10% return on the investment, then you are covered. Plus, you may be able to get more tax advantage with the interest payments. I will share more about investments in a moment. For now, keep in mind that low interest debt is not a big problem. Credit card debts or payday lender debts, however, is a huge problem. The interest rate on credit card is around 20% and the rates for payday lenders is extremely high, between 50 to 200%. Now, don't get me wrong, personally, I like credit cards as a good medium for transactions, and if you use them right, you get a lot of perks. But make sure you pay back the money each month and on time. If you don't, you will lose a lot of money. You will be surprised that right now about 30% of Canadians are in credit card debts, and it's usually not the individual's fault. Credit card companies make the terms and conditions confusing on purpose, and that's because that's how they make their money. Let's look at credit card minimum payments as example. Your credit card statements might say that you have $1,500 in credit card debt. Underneath, you sometimes find a sentence that say you just need to pay $10 before a certain date to avoid penalties. This gives the illusion that you only have to pay $10 to avoid fees. And simply that's not true. You still have to pay the full $1,500 to avoid any fees. If you don't pay the full amount, you get dinged with a 20% penalty. If you keep paying only the minimum payments, your credit card debts will be double in every 4 years. The larger the debt is, the harder it is to escape it. So my advice to you is, if you always have credit card overdues, use all your extra money towards it. Find out why you're trapped in the hamster wheel. Don't think about savings or investment yet, and make paying off your credit card debts as your top priority. It will give you the biggest return and the best chance to build wealth later. Step 3 to build wealth is to reduce spending and increase income. And that's because when you want to build wealth, it's not about how much you make, it's actually how much you keep. You could earn $500,000 a year but spend $490,000. You want to be wealthy even if you have a huge income, so a big income alone doesn't equal to wealth. How can we make sure you keep more of your money then? Well, step 1 is to reduce unnecessary spending. Even tiny expenses can add up. Let's assume, for example, you spend $10 on lunch each day. It doesn't sound much at first. It's only $10 a day, right? Well, if you spend $10 5 days a week, then it will add up to $2,500 a year. But if you bring your own lunch instead, you have an additional $2,500 that you can put in your savings account, invest with it, or use it towards to your credit card debts. And the food is only one example. There are likely many other areas in your life where you can make smarter decisions and free up some money. If you don't have a family and don't need a lot of luxury to live a happy life, you might be able to save up to 40% of your income. You can then use the money for investments. The more of your income you can set aside, the faster you will build wealth. If your family, mortgage, and other responsibilities, it might be less, but that doesn't mean you cannot build wealth at all. Besides reducing your spending, increasing your income is a must as well. And remember, we are living in a skill economy, not a labor economy anymore. Meaning, if you have a skill that you're good at and passionate about, you can monetize your skills. Find something that you're passionate about and see if you can increase your income by 10% every year. Increasing your income is important because no matter what you do, you can only lower your expenses to a certain level. You still always have to pay for food, shelter, there's no way around it. And finally, to make all this easier on you, it might be a good idea to create a budget for yourself. First, track your spending habits and income. Then evaluate your spending habits and create a fitting budget. To start out, you can use a simple budget like this. 50% of your income goes towards your living expenses, 20% for fun money, and 30% for savings and investments. Or if you can live with less fun money, use more of it for investments. Then proceed to reevaluate your budget regularly. Step 4 is creating emergency fund. Emergency fund is a stash of money that you can set aside for emergency and unexpected expenses like a broken car or unexpected bills. Imagine if you didn't have an emergency fund but would need money on the spot, what would you have to do? You have to make money out of your investments or use a credit card, and both aren't ideal. If you take the money out from your investments by selling stocks, for example, there's a high chance that you're losing money if the market is down. What's more, your investments could also be tied up. For example, if you invest in real estate, in such a case, many people use their credit cards to pay for their emergencies, but that bears the risk of ending up with the credit card debt. Now, you might wonder how much money you should put into your emergency fund. Ideally, you will have enough money to cover your expenses for at least 3 months or more. For most people, that could be ranging from $10,000 to $20,000. It's also important that you don't take it too far. There's no benefits of having $20,000 in saving. If the money is just sitting in there, it's better to invest in some investments and get a 7% return instead of 1 to 2%. So what I recommend is to have a personal line of credit or home equity line of credit pre-approved first. Then you can move your troops off to investments. This is important because we don't know when the emergency occurs. It could be tomorrow or it could be in the next 10 years. So we want to make sure every dollar is optimized. Alright, step number 5. Insurance is probably the most underused asset when it comes to building wealth. During your early stage, insurance will be the lowest cost to protect your income and assets. And later on, when you build up the wealth, insurance now can act as a gatekeeper to make sure your asset is more tax efficient and time efficient. There's a variety of insurance for any kind of scenario. For example, I recently recorded a video about critical illness insurance and its benefits. You can click the link at the top to check it out. Either way, leveraging insurance is a smart way to do it, and it acts like a plan B when your plan A falls apart. All steps until here were about protecting your current wealth. It is important, but to actually grow your wealth, you still need one more step, which is investments. You don't need to invest in anything crazy or complicated. Most wealthy people stick to the stock market, real estate, or invest in the business. Most importantly, invest in what you know and understand. The thing with investment is, the majority of people will never do it. Most people need to spend their money or put it in a savings account. But to get really wealthy, you need to make sure your money is working for you. If you invest in certain area, say dividend stocks for example, you can get paid dividend every month. Or if your stocks grow in value and you can sell them off for a profit. What's more, you can use tax shelter accounts such as the tax-free saving, and here's an example of how powerful investment can be. If you're 30 years old and manage to put $500 a month into a tax-free saving, you will save $6,000 a year. If you do that for 25 years and get an 8% return per year, and you will have around $470,000 where your output is only at $150,000. If you use your tax-free saving at this rate and save it until age 65, you will have $1.1 million, and that is completely tax-free. And my last tip for you in building wealth is never rely on the game of luck. Some people want to be wealthy by gambling or playing the lottery, hoping that they will get rich in one day. But do you know what are the odds of winning the lottery? The chances of winning the 649 are 1 in 14 million, and for Lotto Max is 1 in 33 million. Those odds are so long that you're more likely to die because of flesh-eating disease or be killed by a thunderstorm, or you're 3 times more likely to be killed in a traffic accident driving to buy your tickets than winning the jackpot. And even if you do get lucky, how many times that we heard about the lottery winners goes bankrupt again? You cannot just hope to become wealthy in one day. Hope is never a strategy, and it's better to make concrete plans. What's more, make sure your financial goals are SMART, meaning they are specific, measurable, attainable, realistic, and time-sensitive. It really only takes one mistake or one poor decision to go from rich to being poor, but it takes countless micro-successes to become wealthy. So if there's anything you want to take home today, remember this simple 3-part framework. Know your money, protect your money, and grow your money. If you want to know more about this 3-part framework, check out the link in the description box below. I recorded a special masterclass about knowing, protecting, and growing your money. It's completely free, and all you need to do is click the box below. Hey, thanks so much for watching. This is Thomas, and I look forward to seeing you in the next video.